All right, let's jump straight into this explainer because we've got a genuinely fascinating mystery on our hands today. We are looking at a scenario that has left a lot of seasoned investors completely scratching their heads. I mean, why would two massive, incredibly dominant AI titans see their stocks absolutely plummet right after reporting what can only be described as blockbuster, record-breaking earnings? Because look, here's the core paradox we're dealing with. The artificial intelligence sector is booming, right? The companies that actually build the foundational infrastructure for this revolution are just crushing their numbers. And yet, despite delivering what looks like literal financial perfection on paper, cybersecurity giant CrowdStrike dropped 11% and networking monopoly Broadcom plunged 14% right off their recent highs. How does that make any sense at all? Let's unpack the real story hiding behind the algorithms. So let's examine our first suspect, CrowdStrike, and their absolute financial triumph. To really grasp the massive scale of their Q1 2027 success, you just have to look at this number, 34%. That is CrowdStrike's brutal, industry-leading free cash flow margin, which translates to a whopping $468 million in pure cash. Throw in their first ever GAAP positive net income of $27.8 million, essentially zero long-term debt to worry about, and a highly confident 4-for-1 stock split. I mean, they are basically printing money at this point.
And you can see that undeniable momentum when you look at their net new annual recurring revenue. It absolutely surged 32% to hit nearly $256 million for the quarter. That is the exact metric Wall Street obsesses over, and it drove their total quarterly revenue up 26% to a staggering $1.39 billion. That's 4 straight quarters of accelerating growth.
So why the explosive growth? Well, CEO George Kurtz pretty much hit the nail on the head when he called CrowdStrike the picks and shovels for the world's largest technology gold rush. The two heaviest hitters in frontier AI, Anthropic and OpenAI, have both tapped CrowdStrike as their foundational cybersecurity partner. The whole industry is woken up to the fact that you literally cannot deploy AI at scale unless you secure the underlying infrastructure first.
Think about how this actually works in practice. With the massive rise of agentic AI, those autonomous bots out there executing tasks on your behalf, the enterprise attack surface has just exploded. CrowdStrike's Falcon platform is now stepping in as this crucial AI firewall and threat moderator. It's actively protecting against prompt injection attacks and doing the heavy lifting for data loss prevention. It's stopping those devastating enterprise data leaks from feeding into public large language models.
Okay, but here's the million-dollar question. If they're doing so incredibly well, why did the stock tank 11%? Well, simply put, the stock was priced for absolute perfection. It was trading at a heavily overbought forward price-to-earnings ratio of 153x. When expectations are set that astronomically high, simply being great just doesn't cut it. CrowdStrike issued Q2 guidance that merely met analyst expectations instead of totally blowing them away, and their billings growth showed a slight deceleration at 18%. That was all it took to trigger an institutional sell-the-news reaction, which then tripped a cascade of algorithmic stop losses, and boom, down goes the stock. All right, pivoting over to Suspect 2, Broadcom, and their absolute monopoly on AI networks. Just try to wrap your head around Broadcom's hardware dominance for a second. They generated $10.8 billion in AI semiconductor revenue alone in Q2 2026. That is an astonishing 143% growth year over year. AI chips are now eating up 49% of their entire hardware business. They even raised their 2026 forecast to $56 billion, with CEO Hock Tan signaling that by 2027, their AI revenue is going to easily eclipse $100 billion. When you pull back and look at the sheer scale of their Q2 financials, it's honestly breathtaking. Broadcom pulls in a record $22.2 billion in total revenue, up 48% year over year, which, to be fair, was heavily driven by swallowing up VMware. But the craziest part? The margins. They hit an extreme 67% operating margin and a 69% adjusted EBITDA margin. That is $15.2 billion in EBITDA, yielding a 46% free cash flow margin. We are talking about $10.3 billion of pure free cash generated in a single quarter. And the underlying tech making all this possible, it entirely relies on their custom ASIC chips and networking switches, like the Tomahawk 5 and the Jericho 3 AI. You can think of these chips as hardware moderators. They are the ultimate traffic police inside massive supercomputers. When you have tens of thousands of GPUs talking to each other to train an AI model, Broadcom's tech ensures absolute zero packet loss. Right now, they're ramping up these massive custom orders for Google's TPU v7, for Meta, and for a highly secretive third hyperscaler, which pretty much everyone assumes is Microsoft and OpenAI. But it's kind of a tale of two cities for Broadcom right now, and we have to weigh the good against the bad. While that AI semiconductor business is booming at 143%, their traditional non-AI business, things like enterprise storage and broadband, took a temporary 12% hit. Why? Because right now, massive companies are ruthlessly cannibalizing their traditional IT budgets just so they can afford to buy more AI servers. It's a massive shift in priorities. So what exactly spooked the market into wiping 14% off Broadcom's valuation? The market got hyper-focused on that 12% dip in the non-AI segment. Plus, there are some very real rising supply chain fears out in Asia, specifically regarding TSMC's CoWoS packaging and the HBM3E memory chips that are absolutely required to build these AI systems. But honestly, the real nail in the coffin was CEO Hock Tan refusing to raise his already massive $100 billion AI revenue forecast for 2027. Once again, when a stock is priced for absolute perfection, Wall Street interprets holding steady as a major disappointment. Which brings us to the resolution of this whole paradox: multiples compression. If you're worried about an AI bubble popping, don't be. What we are actually witnessing is a phenomenon known as multiples compression. This is a totally healthy, necessary market adjustment where sky-high valuation multiples, like that crazy 153x PE ratio we saw with CrowdStrike, finally come back down to earth. A bubble bursts when the underlying business is fake or failing. Multiples compression simply happens when the business itself is thriving, but the stock price just temporarily ran a little too far ahead of reality. You really have to separate the algorithmic panic from the actual financial reality here. Both CrowdStrike and Broadcom possess massive, nearly insurmountable technological moats. They are literally the critical infrastructure powering the AI revolution. They have incredibly healthy balance sheets, essentially zero long-term debt, and they are generating billions upon billions of dollars in pure free cash flow. The core businesses are only getting stronger, even if the stock price took a short-term hit. So here is the ultimate question to leave you with today. If the foundational economics of the AI revolution are completely intact, and the moats of these titans are only getting wider, is this multiples compression actually a rare retail buying discount? I'll let you decide if this market overreaction is the exact opportunity you've been waiting for to invest in the infrastructure of our AI future. Thanks for diving into the numbers with me today.